Hello and welcome to our new investment strategy update. A late cycle is taking shape as economic dynamics normalize in this year of transitions. The shock of inflation is fading as high interest rates take hold. But while activity is slowing, there's no major sign of a recession yet. In the US, two opposing forces are at work. Tighter credit is putting a brake on housing, investment, manufacturing, and trade. But strong job markets and consumer savings are supporting demand. As a result, the US economy is only cooling very gradually, and this has major implications for the Federal Reserve. With most monetary tightening behind us, the Fed has now to keep the pressure on the economy with high rates at least until early 2024. That means that most of the impact is still ahead of us, and as tougher credit conditions weigh on capital expenditure, corporate profits, and the labor market, a short, mild recession is likely in late 2023 or early in 2024. In Europe, the energy shock is past, although growth still faces headwinds because fiscal support is fading. Besides, the European Central Bank's restrictive monetary policy will continue to fight still high inflation. China, on the other hand, is on a different path. Can its uneven rebound continue, given fragilities in real estate and manufacturing, and as global demand slows? That's a key question for investors, and we believe domestic consumption should help China achieve 5.5% growth this year, with inflation too low for policymakers' comfort, leading to extra policy support in the second half of the year. In Japan, the economic fundamentals look healthy, and the central bank should end its policy of yield curve control very soon. Overall, global macro risk have shifted from inflation to growth. Inflation is indeed retreating in developed economies, and while there's little risk of a hard landing, high rates will act as a brake on demand. We see this as a more relatively controlled emergency lending than a soft one. Let's now hear from Mark what this means for our portfolio positioning.
Markets rose as inflation fell despite the slowing growth outlook that Sami just described. In the next phase of the cycle, portfolio resilience is key. That means a neutral exposure to risk assets and a defensive bias within asset classes to enable portfolios to navigate a broad range of economic outcomes. We remain neutral in equities, favoring quality stocks and consumer staples for their typical better late cycle performance. Of course, much depends on corporate earnings, and with interest rates high, profits in the US are bound to slow as the recession nears. As a result, we prefer stocks in Europe, Japan, and China. We keep a positive bias to fixed income. Within the asset class, we favor quality, expressed via an overweight in US Treasuries and investment-grade credit. In currency markets, we expect the US dollar to weaken further, especially against the Japanese yen and the Swiss franc. In commodities, we have raised our allocation to gold and expect its price to reach $2,100 per ounce. Oil prices should also increase to around $90 per barrel, given OPEC's production cuts and robust demand. As the economic cycle enters its final stage, we continue to put capital to work tactically. We also seek to capitalize on the long-term shifts at work, from slowing potential growth and aging population to geopolitical fragmentation reshaping global trade patterns, all while artificial intelligence promises to impact almost every sector. And crucially, the transition to a net zero world that is attracting unprecedented levels of infrastructure spending and creating new opportunities for investors. Thank you very much for watching.